What does this mean for people outside of the Silicon Valley Bank universe? What does this mean for the average borrower, if anything?
So far, it doesn't mean anything, but the big question is one of contagion. That is, what we saw in 2008 was when one big bank and a couple of others started to fail, could not pay their depositors, could not actually pay up what they owed. They were closed, and regulators had to move in very, very quickly. But we ended up with a financial crisis because, one big banking card easily starts tipping over other cards. It's a house of cards. Now, we don't know yet about contagion. What we do know is that this bank was obviously overextended. And this is related to the Fed because as interest rates went up and this bank was lending to a lot of startups, this bank simply could not handle it. I think that this is the biggest economic news today. It is not this jobs report. The jobs report was good, and it's kind of signals to me a soft landing. But I think that in terms of what the Fed is going to do, this bank implosion, this potential contagion, may reverse Jerome Powell's direction. It may lead to, instead of a half a point increase at the March meeting, it may lead to no increase at all. In fact, it's even conceivable that interest rates start dropping. The fear that we're going to be in deep trouble.
You have advocated for the Fed to stop increasing the interest rate. Why? Before this issue with Silicon Valley Bank.
Simply because I don't see any wage price inflation. Wages, according to Jerome Powell, are pushing up prices. Well, that's simply not the case. Look at today's report, for example. We're seeing the smallest wage increase in over a year. Prices continue to rise. That is absolutely true. But wages are not pushing them up. It's not that workers are doing so wonderfully well. What's pushing up many prices domestically is big companies that want to increase their profit margins. And so they have monopolies or near monopolies, oligopolies. They are using the opportunity, using inflation as an excuse to put up their prices. So this is at its bottom here. It really is an antitrust monopolization issue. It is not a Fed interest rate problem.
So you suggest that the Fed should stop increasing the interest rate. But if that is the only tool they have, I imagine you're going to correct that assumption. But if that's the only tool they have to try to bring it back down to the 2% rate, that goal, then what else can they do to try to tame inflation, if not increase the interest rate?
Well, first of all, let me just say it's not clear that they have to do anything else. Inflation is starting to come down. Now, we'll find out more Tuesday when the inflation report, the consumer price increase report, inflation report will be coming out. But as of what we know now, inflation is slowing slightly. And the key here is the direction. If inflation were increasing, that would be one thing. But if inflation is starting to slow down, if we're seeing it going in the right direction, then it's not clear that the Fed has got to keep raising interest rates and risking a recession that's going to hurt everybody.